Okay, let's take a look at different depreciation methods. This is just a review. We covered this in class. You covered it in your homework, but this is just a practice and review, so we kind of get on the same page. Pizza bought a Toyota delivery van. It was 18,600. This is an important amount because this is a number we start with when we're deciding how much to depreciate. The van was expected to remain in service for 4 years. 4 years is important when we're talking about straight line. 57,000 miles is how the amount of mileage that is anticipated. At the end of its useful life, tasteful officials estimated that the residual value would be 1,500. Remember, 1,500 is important for straight line. We'll show you here in a second. That's how much, because we don't depreciate residual value. The van traveled 20,500, so number of years, or excuse me, number of miles. Let's go ahead and get into straight line. So straight line, what would it be? Well, when you're doing a straight line calculation, you take the cost and you subtract residual value. Straight line, you consider residual value. So here you have 18,600, 1,500. What you have available to depreciate is 17,100. That's over 4 years, 42.75 per year. And we get our total, 42.75 times 4 is a magical 17,100. You will notice it magically matches this figure right here, which is the cost minus the $1,500 salvage value or residual value. So that's our straight line. Now let's do units of production. I did want to mention something here. This is 42.75 per year, right? So you bought it, you bought it January 2nd, 2014. You basically are taking a full years for 2014. Please don't, unless it tells you to depreciate by number of days, don't get wrapped up around this, it's the 2nd of January. And if it had been bought, let's say that it had been bought on July 1st. July 1st is exactly halfway through the year. If it had been bought on July 1st, 2014, halfway through the year, you would not take a full 42.75, you would take half of that. And then the next year you would take a full 42.75 because it represents a full year. You would end up with this on the backside with another half year worth of depreciation to make the full 4 years. But just be conscious that this is per year. If it's 3/4 of a year, you take 3/4 of this. If it's a 1/12 of a year, it's a 1/12 of this. This just happens to be even because it's exactly 1 full year. Okay, now let's talk about units of production. When you're looking at units of production, you notice that this car, I should say this van is able to create 57,000 miles of production. Be no different than a factory who could work, or a piece of machinery that could work 57,000 hours, that kind of stuff. But this is a van that runs 57,000 miles. Notice here, let me just lay it out here. We're going to take the amounts per year, 20,500, 16,000, 15,400, and 5,100. I took this right off of the years, first year, second year, third year, etc. But first we got to establish what we multiply this by. How many cents per mile we need to take every single year. This is the first year, etc. You start by considering the cost, which is 18,600, right here, 18,600. Just like in straight line, notice that you're considering the residual value. You're not depreciating the residual value. You're subtracting it out to get the 17,100, which can be depreciated. And then simply you divide that by the usable number of miles, which is 4 years. In this case, we're not doing straight lines, so we're not as focused on the years. We're looking at the miles, and it's 57,000 miles, and that gives us a rate of 30 cents per mile. So now we just multiply this each year by 30 cents. And let me calculate out. Okay, what I've done is just done the calculation so we don't have to tediously go through them one by one. And all I did was take the respective year's mileage times the 30 cents. You notice you come up with your amounts here. You'll also notice the total amount of dollars by year equals 17,100, which happens to be what you depreciate, 17,100. Again, just like straight line, don't depreciate residual value. So now we just go ahead and put our numbers in. 6150, I think it's 4,800, 4620, and 1530. Notice that once again, 17,100 is what we end up with. All right, so now let's look at double declining balance. Let's take the first year, okay? The first year is going to be, well, let's look first at how double declining balance is constructed. Double, the double here is that you take the regular straight line rate. Notice the regular straight line rate would be 4 years, right? It's going to be in service for 4 years, and we would take a quarter every year, right? So we would take, that's what this whole business is about. We're taking a quarter, a quarter, a quarter, a quarter, until we equal to 17,100. Notice straight line is taking salvage value or residual value into account. Units of production is taking salvage value or residual value into account. Double declining balance is not going to until the last year. Okay, so it ignores salvage value until the last year. That would be 2017, the fourth of these 4 years. So this is what the straight line rate would be. That's 0.25 per year, right? And the double part of this is right here. We're going to double that rate and make it 50% of 50%, or another way to say it, half of the net book value each year. Well, that begs the question, what is the net book value in year one? Well, the cost is 18,600. Notice we're ignoring salvage value, minus the accumulated depreciation, which is 0 because we haven't taken any depreciation yet. Remember, the accumulated depreciation is the entry we make where each year we do depreciation expense, and then we credit accumulated depreciation. And accumulated depreciation is a contra asset that lowers the value of that asset, hence net book value. Depreciation's been taken against it. But in this case, year one, we've taken nothing, so net book value is 18,600, and we take half of that, and that's $9,300. Notice it's quite a bit more than what we've taken with the other methods, and that gives us the depreciation in 2014. Let's look at the 2015. Year two, we're going to do the same procedure. Again, we're not paying attention to salvage value until the last year, but year two, we have once again the same cost, 18,600, because we're trying to get to net book value. And net book value is cost minus the latest accumulated depreciation. It's still 18,600, but now we do have some accumulated depreciation because we took 9,300 last year. So we take cost minus accumulated depreciation. That's how much depreciation we've taken to date. And that leaves us 9,300. Of course, 9,300, we took half. So what's left is the net book value in year two is 9,300. Take half of that, and again, double declining balance gives us 4,650 in year two. Now let's look at 2016. So in year three, once again, the procedure is the same. I went ahead and put it up here at the top. Thought it'd be easier to keep track of. Again, you take the cost and you take the latest version of all the depreciation you've taken. You'll notice that you took this much in year one, you took this much in year two, and the sum of these two is the very latest version of accumulated depreciation, hence the sum of all the depreciation you've taken thus far, and it gives you a net book value of 4,650. And remember, double declining balance takes its rate that is calculated against the latest version of net book value. That's why you go through all this rigmarole. 4,650 times 0.50 is 2325. So that's what you take in year three. Now let's look at the last year, because it's kind of extra special under double declining balance. Notice, again, I'm trying to beat the repetition into you. Straight line took into account the residual value. Units of production took into account the residual value. Notice that double declining balance did not until the last year. Let's look. So in the last year, again, the mechanics are somewhat the same, but they change a little bit. So the last year, again, once again, cost. Notice once again we're ignoring residual value. We're going to pay attention to residual value in a minute. We take the latest version of accumulated depreciation, which is a fancy word for all the depreciation we've taken thus far. Well, we know we took 9,300. Let's change color here. We know we took 9,300 in year one. We know we took 4,650 in year two, and we know we took 2,325 in year three. So if you add that to 2,325 for year three, 4,650 for year two, 9,300 for year one, you come up with 16,275. That gives you the latest version of net book value. But that last year, instead of multiplying this by the double declining rate of 0.50, you don't do that. Don't multiply out the very last year. What you want to do is you take the latest version of net book value, which is 2325, subtract the salvage value. Now we're taking account of residual value or salvage value. Take, right here, take salvage value out, because we do not depreciate salvage value. None of the methods depreciate salvage value. Double declining balance, what's strange about it is it really only pays attention to it at the end. Subtract that salvage value, and this is what you've got left. And what you've got left is the 825. Take a quick total, 9,300 plus 4,650 plus 2,325 plus 825 gives you the magical 17,100. Notice we did not depreciate our salvage value. We took 18,600, and then when we were doing our calculations, we ignored it in year one, year two, year three. But when we went to the very last year, we were careful not to depreciate salvage value. We did not take the remaining net book value. We preserved 1,500 and took the 825. And that's how you do double declining balance. Here it says, which method best tracks the wear and tear on the van? Well, the wear and tear on the van is units of production. That's what keeps track best of how bad we're using the truck. It says, which method would Tasteful prefer to use for income tax purposes? Well, for income tax purposes, you want to try to depreciate. You want to try to put on your tax return as much as you can early, because that saves you taxes. Generally speaking, what you want to try to do in tax planning, is to try to put off paying as quickly as possible. Well, in year one, we would be able to depreciate 4,275, so we'd be able to lower our net income by 4,275 with units of production 6,150, but with double declining balance, we could depreciate 9,300. So we would prefer double declining balance for that. It provides the most depreciation, especially early. So double declining balance helps you here. It helps you because you have $9,300 early. Notice that when we get to year two, units of production is slightly higher, but generally speaking, that first year, the more you can write off, the better. So double declining balance is preferred. It depreciates more of the asset early, so you can write it off your tax return and pay less taxes. It provides the most depreciation in those early years and thus has the largest tax deductions in the early life of the asset. This is how you do the three different methods that we cover. I would say double declining balance, be sure you practice that, because that's a little bit strange in how you ignore salvage value except at the very, very end. I hope you found this useful.